July saw a couple of interesting milestones on markets. Generally, markets were positive. I'm sure there were definite catalysts through the month, but if you look from point to point, it was a bit of a muddle higher through the month, so 2 to 4% higher depending on which markets you're looking at. But $300 billion and $4 trillion, you think of all the numbers and zeros that are behind those data points. For Australia, CBA crossed over $300 billion market cap milestone, first company in Australia to do that, and in the US you saw Nvidia cross over $4 trillion. So boggling numbers in terms of the size of these businesses, and I suppose that's the breadth. Certainly for Nvidia, it's a global business and in the right spot at the right time at the moment. Growth outlook's interesting to watch. So the earnings outlook for that business is starting to get a bit tighter. So lower growth profile, talking still double digits, but slowing down from what it has been. So people have got their chips and they're deploying those chips into whatever they're using them for, from data centers or other areas that utilize them. But it's slowing in terms of what the demand is for those outputs for Nvidia. From an Australian perspective, so CBA, biggest company in the country at the moment, over 10% of the index here. No real catalyst. There is some short-term money that's seemingly parking exposure in CBA at the moment. It's a liquid position. It's a very high-quality business, a very low-growth business from where we are at the moment. So it'll be interesting to watch what the share price does going forward. It weakened a little bit, as did some of the other financials through the month, and there was a bit of a rotation domestically into some of the healthcare businesses, which had been a little bit unloved. So probably a bit of a rotation into better valuation opportunities for some that are in Australia. Bond markets were relatively flat in the month, so there's been volatility intra-month, but effectively, the mid 4-point-something percent, 4.2, 4.3% yields for bond yields has been relatively stable, and has been for a number of months now. And there's differences in the curve now, so the shorter end of the curve is dropping away, so yields are falling. They're reasonably linked to cash rates, so that's the markets sort of suggesting there's signs of inflation dissipating, and there's pressure from central bank or on central banks, not from central banks, but on central banks, certainly in the US, to try to move rates lower. The long end of the curve, as we've been talking, is still pressure. So the auctions are finding it more difficult to get more and longer term deals away. So the 10s and 30-year Treasury securities are not going to auction at a strong rate compared with what they have done in the past. And you're talking minor adjustments or minor differences between a good auction and a poor auction. But it shows signs that there's concerns around long-dated securities, which we've been talking about, that the US debt position, the government debt position, is large and growing. The interest costs, if rates stay where they are or increase, is a big impost. Beyond Social Security, the interest cost is the second highest budget item for the US government now. That's a challenge, that's a concern, and that's something that's questioned, or markets are questioning. And so, what does that mean? Well, it means interest rates are likely to go higher for longer term securities. It means for people that have got exposure to that prices come down, so you get a negative impact when yields go up. So you've just got to be cautious with where you're playing fixed interest at the moment. At the moment, be rebalancing, so making sure that you're not overexposed to things that are really expensive. So being cautious with market valuations. Deploying slowly, so if you do have new money to deploy, you're doing it progressively, not in a big hit, but finding opportunities where you can. So as I said, that healthcare opportunity, we've got managers that would be looking at different valuations and comparable valuations. relative valuations, so one sector versus another, one company versus another, and rotating into what they're seeing as better valuation for the medium to long term. So that's what we're looking for in managers, to be active in this space at the moment and find opportunities where there are, and being cautious in expensive parts of the market. But still, across the spectrum, we're still confident, cautiously confident on the outlook that earnings growth outlook across the world is probably still okay. Just being careful with valuations, and thinking of fixed interest, being cautious with that long end. Just being aware that these are or should be defensive assets. The longer you've got exposure for, the more capital risk there is if rates change. And so we've got managers and we've got positions that are probably more shorter term. Just being cautious with what that longer term uncertainty is with fixed interest rates. Domestically, if you look at the Aussie currency, it's been grinding higher. It's just slowly creeping higher through this year. I think we sort of started at 62 or 61 cents and we're at about 65.5 now. There's been some volatility through that as the tariffs got announced, and there was concern around, I suppose, a flight to quality back to US dollars, and that saw a drop in the Aussie since the confidence around the fact of what the tariffs were going to be implemented, which we'll cover. The confidence that was not going to be too much of an impost saw the currency recover very, very quickly. It's ground higher to around that 65.5 cent level now. It should continue to grind a little bit higher, and some of that will be down to interest rate differentials, cash rate differentials between here and the US. At the moment, the US rate's better than what the Australian rate is. You may still see some reductions in the cash rate here, but you'd expect that the US would be looking to reduce. I think there's a couple of reductions priced into the Fed cash rate over the next 6 months. And so that all of those sort of go into the mix in terms of what the currency outlook is, mixed in with the US debt position, the government debt position, which is clearly the big uncertainty or outlier at the moment, which is a concern. We had April where we had the release in the big board of all the data of all the proposed tariffs, which everyone was sort of scrambling to get their heads around how it was actually being put in place. There's been negotiations and extensions and further negotiations. The impact is, I think most people were sort of suggesting it was a 15 to 20% standard or average tariff that would come into force, which I think is probably close to where we are today. So with early April passing, when the tariffs were going to be implemented, they've come in, and it's markets have sort of bumbled along and moved through that without too much of an impact or concern.